Warren Buffett's 5 Secret Rules to Become a Millionaire. Warren Buffett is considered one of the greatest investors of all time, with a net worth of over $100 billion. But how did he get there? What are his secrets to success? If you want to become a successful investor, then pay close attention, because these rules could change your life. This is Finance Ventures, and we are here to help improve your financial future. Make sure to subscribe and hit the like button if you found this video helpful. Investing is not a game where the person with the high IQ beats the person with the low IQ. It's about discipline, patience, and temperament. Warren Buffett has been sharing his investment strategies for decades, and today we're going to break down his 5 golden rules of investing. Rule number 1. Invest in what you understand. Warren Buffett believes that investing in what you know and understand is crucial for success. This means that he only invests in companies that he can comprehend and has a clear understanding of their business model, industry, and financials. One of the main reasons why Buffett emphasizes this rule is that he believes that investing in something that you don't understand is a recipe for disaster. It can lead to making impulsive decisions based on incomplete or flawed information, which can result in significant financial losses. Buffett has famously avoided investing in technology companies, despite their rapid growth and popularity. He has said that he doesn't invest in something that he can't explain to a 6th grader. This philosophy has served him well over the years, as he has been able to focus on industries and businesses that he understands well, such as insurance, consumer goods, and banking. Investing in what you understand also allows you to assess the risks and potential rewards of a particular investment more accurately. If you have a clear understanding of a company's business model and industry, you can more easily predict how changes in the market or economic conditions might impact its performance. This first rule of investing emphasizes the importance of investing in what you understand. It's a strategy that has served him well over the years and can be a useful guiding principle for investors looking to create long-term wealth. Rule number 2. Invest for the long term. This means that he is a strong advocate of buying and holding quality stocks for an extended period, sometimes even for decades, rather than attempting to time the market and make short-term trades. Buffett's approach to investing for the long term is based on the principle that quality companies with a strong competitive advantage, excellent management, and solid fundamentals will ultimately grow and provide returns to their shareholders over time. He looks for companies with a proven track record of profitability, consistent earnings growth, and a sustainable business model. Buffett has famously said that his favorite holding period is forever, and he has held on to many of his investments for decades, including stocks like Coca-Cola and American Express. He believes that buying and holding allows investors to avoid the transaction costs and taxes associated with frequent trading, and also minimizes the emotional roller coaster that can come with trying to time the market. Another advantage of investing for the long term is the power of compound interest. By reinvesting dividends and allowing your investments to grow over time, you can benefit from the compounding effect, which can significantly boost your returns in the long run. This second rule of investing highlights the importance of investing for the long term. By focusing on quality companies and holding on to them for extended periods, investors can benefit from the power of compound interest, avoid transaction costs, and minimize the emotional stress of trying to time the market. Rule number 3. Don't follow the crowd. Be fearful when others are greedy, and greedy when others are fearful. This principle is based on the idea that investing based on popular opinion or the latest trend can be a risky approach, and that successful investors need to be independent thinkers and avoid herd mentality. Following the crowd can lead to a phenomenon called groupthink, where individuals within a group tend to conform to the group's prevailing attitudes and beliefs. This can result in the group ignoring critical information, making irrational decisions, and engaging in excessive risk-taking. To avoid this, Buffett advises investors to be independent thinkers and to conduct their own research and analysis before making investment decisions. This requires having the courage to go against the prevailing wisdom and make decisions that may not be popular at the time.
Buffett has often emphasized the importance of being a contrarian investor,
or going against the grain and investing in companies or industries that are out of favor with the market. This approach can be difficult, as it requires the patience and discipline to hold on to investments through periods of short-term market volatility and uncertainty. Another key aspect of not following the crowd is avoiding fads and market trends. Investing in the latest hot stock or industry can be tempting, but it can also be a recipe for financial disaster. Instead, investors need to focus on the long-term fundamentals of companies and industries, and invest based on their own research and analysis. This third rule of investing highlights the importance of avoiding herd mentality and not following the crowd. By being independent thinkers, conducting thorough research and analysis, and avoiding fads and market trends, investors can make more informed investment decisions and increase their chances of success. Rule number 4. Buy low and sell high. This principle is based on the idea of value investing, which involves finding undervalued companies with strong fundamentals and purchasing their stocks when they are trading at a discount. The concept of buying low and selling high may seem obvious, but it is often easier said than done. Many investors get caught up in the hype surrounding popular stocks, causing their prices to skyrocket and end up buying at the top of the market. This behavior can lead to significant losses if the market corrects, or the company's performance doesn't live up to expectations. Buffett's approach to buying low involves identifying companies with a solid track record of earnings and a stable business model that have fallen out of favor with the market for temporary reasons. He looks for companies with a strong competitive advantage that have the potential to bounce back over time and provide returns to shareholders. Selling high involves recognizing when a stock has reached its true value and has become overvalued. This can be challenging, as some popular stocks can remain overvalued for extended periods, and it can be tempting to hold on to them for fear of missing out on further gains. Buffett advises against this approach and suggests that investors should have a clear exit strategy in place and sell when the stock has reached its true value. This fourth rule of investing emphasizes the importance of buying low and selling high. By investing in undervalued companies with strong fundamentals and selling when the stock has reached its true value, investors can maximize their returns while minimizing their risks. And rule number 5. Have patience and discipline. The stock market is a device for transferring money from the impatient to the patient. This principle is based on the idea that successful investing requires a long-term perspective, discipline, and the ability to avoid making impulsive decisions based on short-term market movements. Investing is a long-term game, and it's important to have patience and discipline when it comes to making investment decisions. Buffett advises investors to adopt a buy-and-hold strategy, which involves purchasing stocks in high-quality companies and holding onto them for the long term. This approach requires the discipline to resist the urge to make impulsive decisions based on short-term market movements or other external factors that may impact a stock's price in the short term. Instead, investors need to be patient and have the discipline to stick to their investment strategy even during periods of market volatility or uncertainty. Buffett has often emphasized the importance of avoiding market timing, which involves trying to predict short-term market movements and making investment decisions based on those predictions. Market timing is difficult, if not impossible, to get right consistently, and can lead to significant financial losses if investors make incorrect predictions. Another key aspect of having patience and discipline is being able to ignore short-term market noise and focus on a company's long-term fundamentals. This requires a long-term perspective and the ability to assess a company's competitive position, management team, and growth potential over a period of several years or more. This fifth rule of investing highlights the importance of having patience and discipline. By adopting a buy-and-hold strategy, avoiding market timing, and focusing on a company's long-term fundamentals, investors can increase their chances of success and avoid the pitfalls of short-term thinking. So there you have it, Warren Buffett's 5 golden rules of investing. Whether you're a beginner or an experienced investor, these rules can help guide you towards long-term success. Remember, investing is a marathon, not a sprint, So be patient and disciplined, and you could be on your way to building a fortune just like Warren Buffett. Thank you for watching, and if you learned something new today, give the video a like and share it with a friend. See you in the next one.